The world in which, not so long ago, it seemed possible to negotiate, bargain, and balance interests through complex diplomatic frameworks no longer exists as it once did. It did not collapse in an instant, nor was it shattered by a single dramatic event, nor destroyed by one war or crisis. It simply began to unravel, like an old fabric worn thin by decades of compromise, hypocrisy, and accumulated contradictions. And now we are witnessing precisely this phase, the phase of unraveling, when familiar structures such as alliances, treaties, and international rules still formally exist, but in reality are ceasing to function. The global order that was formed after World War II and finally solidified at the end of the Cold War was built around one key idea: the United States as the unquestioned center of power, guarantor of security, issuer of the world's reserve currency, and the main arbiter. All other countries, in one way or another, fit into this system, accepting the rules of the game in exchange for access to markets, technologies, and relative stability. But any system based on the dominance of a single center sooner or later begins to crack, especially when that center is no longer able to bear its former burden. America today is overwhelmed by internal problems, debt, social division, and the loss of consensus within its own society. And it is precisely at such a moment that a politician comes to power again, one who does not think in terms of complex multilateral agreements, but in terms of force, pressure, and direct benefit. For Trump, the world is not a delicate system of balances, but a huge marketplace where the winner is the one who shouts the loudest, applies the most pressure, and issues the toughest ultimatums. And in this sense, his logic is absolutely consistent. Venezuela became, for him, an example of how one can act against weaker players without serious consequences. This created the illusion of permissiveness, the feeling that the world can once again be reshaped by brute force without facing any response. It is precisely this feeling that drives him to seek out new pressure points, where the goal is not so much actual conquest as it is to demonstrate a willingness to go all the way. In this context, Greenland becomes the perfect symbol. It is, at the same time, far enough from the average voter's attention, possesses enormous strategic value, and yet formally belongs to an ally. This makes the situation as provocative as possible. Trump's statements about Greenland are important not because he actually intends to send troops there, but because they demonstrate a new level of what is permissible in world politics. Just 10 years ago, such words would have sounded absurd or like a joke, but today they are becoming part of the real agenda to which governments, markets, and military headquarters are forced to respond. This is the main danger of the moment. The boundaries of what is permissible are shifting rapidly. Europe, which for decades had grown accustomed to living under the American security umbrella, suddenly finds that this umbrella can be used against it. And this is a fundamental psychological shift. When an ally begins to threaten an ally, the very idea of an alliance loses its meaning. This is not just a crisis of NATO, it is a crisis of trust itself. After this, Europe will inevitably begin to rapidly seek its own agency, its own centers of power, and its own mechanisms of defense, even if it continues to publicly maintain the appearance of unity. Against this backdrop, the East appears much more focused and pragmatic. China, Russia, Iran, and India do not form a monolithic bloc, but they are united by a common understanding that the era of a unipolar world is coming to an end. They harbor no illusions about rules and values. They proceed from the reality of power, resources, and control. That is why their coordination is strengthened not through loud statements, but through infrastructure projects, settlements in alternative currencies, long-term energy contracts, and military presence in strategic regions. In this reality, resources once again come to the forefront. Not abstract financial instruments, not complex derivatives, and not fancy presentations, but tangible physical things: oil, gas, metals, logistics routes, ports, straits, and territories. In this sense, Greenland is a concentration of all the key interests of the 21st century. The Arctic is ceasing to be a frozen periphery and is turning into a new frontier where the military, economic, and technological interests of leading powers converge. That is precisely why the struggle for Greenland, even at the level of rhetoric, is so important for understanding the future. It shows that the world is entering a phase where deals are once again made not in conference rooms, but under the threat of pressure, where borders formally remain, but in practice are blurred through leasing, control, bases, and agreements, where sovereignty becomes a relative concept, dependent on the ability to defend it. For financial markets, this means one thing: increased uncertainty and volatility. Money hates uncertainty, but at the same time, it is always searching for a safe haven. Historically, during such periods, defensive assets have come out on top. Gold, commodities, and those instruments that are not dependent on a single country or a single financial system. This is precisely where the question of cryptocurrencies arises. Bitcoin was originally created as a response to the crisis of trust in government-issued money, and every new round of geopolitical tension brings it back to the center of discussion. On the one hand, it remains a risky asset, sensitive to liquidity and market sentiment. On the other hand, it is increasingly seen as a digital analog of gold, as a hedging tool against systemic risks and political decisions. In the short term, escalations like the current one do put pressure on the crypto market. Capital moves into cash, bonds, and gold while waiting to see how events unfold. But in the medium and long term, it is precisely such crises that undermine trust in the fiat system and strengthen the arguments in favor of decentralized assets. The more states threaten each other with tariffs, sanctions, and force, the greater the demand for alternatives that are beyond direct control. Trump understands this intuitively, but acts according to his own logic. For him, the main thing is the effect here and now, a television image of strength, pressure, and victory. That is why the most likely outcome of this whole story will not be war, but yet another deal, presented as a triumph. Tensions will ease, markets will breathe a sigh of relief, risk appetite will begin to return, and investors will once again shift their focus from geopolitics to the economy and profits. Until the elections, Trump will be as cautious as possible in his actions and as aggressive as possible in his words. He will pressure, threaten, set deadlines, and negotiate, because this reinforces his image. But actually, crossing the red lines is too dangerous, even for him. And it is precisely in this gap between rhetoric and reality that opportunities for the markets are being formed today. It is precisely at this point that the logic of everything happening finally comes full circle and turns not just into a set of scattered news items, but into a coherent picture of capital movement in an era when familiar benchmarks are breaking down. We no longer live in a world where markets react to a single factor or a single number in a report. Today, money moves under the pressure of several forces at once, which often pull the system in different directions, creating that very nervous, erratic dynamic for which most investors are psychologically unprepared. On the one hand, there is political noise, tariffs, ultimatums, threats of trade wars, and a constant escalation of uncertainty. On the other hand, there is the cold mathematics of liquidity, balance sheets, and money flows, which ultimately determine where the market will actually go. And this is exactly where most people make mistakes, because they get too caught up in the headlines and pay too little attention to the real money flows. When the Fed starts buying treasury bills, it's not just a technical operation, it's a direct signal to the markets that the system is not ready to withstand the current level of stress without support. Even if formally this is not called quantitative easing, the effect on financial conditions remains exactly the same. Money becomes a bit cheaper, more accessible, and this is immediately reflected in the behavior of major players. They start cautiously building positions where there is asymmetry, where the risk seems temporary and the potential for recovery is above average. And it is precisely the crypto market that at such moments becomes the perfect platform for these kinds of strategies. It is still young enough, volatile enough, and at the same time global. It has no single regulator, no central bank you can call and ask to intervene. But at the same time, it instantly reacts to changes in dollar liquidity because the majority of trading, settlements, and derivatives are still tied to the dollar. This creates a paradoxical situation. Politicians, through their actions, undermine trust in the old system, while central banks are forced to support that same system with money so that it doesn't collapse too quickly. And it is precisely in this gap between the destruction of trust and the printing of liquidity that space emerges for the growth of alternative assets. Not because they are perfect, but because the old instruments stop fulfilling their functions without side effects. In this configuration, Bitcoin becomes something in between a risk asset and a new type of safe haven asset. It drops during the initial waves of panic because speculators and leveraged positions exit, but then it starts to recover more quickly, as long-term players use these dips as entry points. And the more often the world faces such crises, the faster the market learns this behavior. Altcoins, meanwhile, remain more vulnerable. They suffer more during the panic phase and grow more during the euphoria phase. That's why in the current environment, the key is not just to make money, but to survive without making critical mistakes. To understand where the noise ends and the real trend begins, where the news has already been priced in, and where it is just starting to affect capital flows. Trump's trade wars are not unique in this sense. They only accelerate processes that have already been set in motion. Globalization as we knew it is coming to an end. The world is ceasing to be a single economic system and is gradually breaking up into blocks, each of which will protect its own interests, its own markets, and its own supply chains. This means less efficiency, higher costs, and greater inflationary risks in the long term. And where there is inflation and instability, there is always demand for alternatives, not necessarily immediately widespread and conscious, but gradual and growing. First through institutional investors who are seeking diversification, then through corporations which hold part of their reserves outside traditional instruments, and only after that through retail investors, who always come last and pay the highest price to enter. That is why it is so important now to focus not on whether Bitcoin will rise tomorrow or next week, but on the direction in which the very structure of the world is changing. And this structure is clearly moving toward greater fragmentation, less trust, and more manual control over the economy. In such a world, there are no perfect assets, but there are assets that are better adapted to chaos. Trump here is not the cause, but the catalyst. He did not create these processes, but he accelerated them and made them more apparent. His style, his rhetoric, and his methods simply strip away the system's masks, revealing that behind the fine words about alliances and values, there have always been hard interests. As soon as the balance of power shifts, these interests come to the surface. For investors, this means the need to stop thinking in terms of the calm past. There will no longer be long periods of predictability where it was enough to buy an index and forget about it for years. Volatility is becoming the new normal. Sharp moves, unexpected reversals, and political shocks will happen more often. And in such an environment, the winners won't be those who guess every piece of news, but those who understand the overall logic of money flows. Crypto, in this sense, is not a panacea, but an important element of strategy. It doesn't eliminate risks, doesn't protect against all downturns, and doesn't guarantee growth. But it gives you the opportunity to participate in the global redistribution of capital that is happening right now. And the further the world moves away from the stable model of the past, the more valuable such instruments become. That's why the current market phase is neither the end nor the beginning of a bull market in the classic sense. This is a transitional state, where old benchmarks are breaking down and new ones are only just beginning to form. There will be a lot of noise here, a lot of false moves, and a lot of emotional decisions. But it is precisely here that positions are established which will seem obvious in the future, even though today they appear risky. If you look at what's happening without emotion, it becomes clear that the world isn't moving in just one direction, it's simply changing shape. And money, as always, will seek out those forms where there is less control, more flexibility, and a higher chance of preserving value in conditions of global uncertainty.